All right, I can hear on my headphones.
Oh yeah, Adam, can we hear you? Can you hear us?
I can't tell you if you can hear me, but I can hear you. Wonderful.
Can you hear us?
Yes, yes, I can. Yes, I can hear you.
Can you hear us with the correct quality of audio, do you think?
I think so. You sound great. You sound like a millennial podcaster.
You're not hearing a difference now. It sounds good still.
It sounds great.
I think that they may have very badly broken the Discord app on Pixel. Because so my green bubble was moving, Adam.
I believe you. Everyone in chat is saying that the iPhone audio sounds significantly better.
Well, there's only one conclusion there.
You know, if I'm not in a mood to defend Pixel right now, I gotta tell you, you're catching me at a good moment. Like if you're trying to sell me, if this is the iPhone salesman coming here, I gotta tell you, like you're
at the right time.
You are catching me at a vulnerable moment because that was a pretty frustrating experience. We're gonna have to debug that offline, but that is something that has always worked. I've always come in on my Pixel, and because it's got the best quality audio, I'll have people know. Although maybe we can do a. So yeah, Adam, that was a very strange moment where we could hear you and you could obviously not hear us. So.
No. But welcome. I'm glad you're here. So everyone's glad you're here, I think.
Yeah, I'm gonna need. Unfortunately, now we need Steve's Face ID to unlock this goddamn thing because we're on Steve's. Okay, so I was listening to the Series B podcast, and I don't think I was in the litter box. Steve, you were in your car, and I was somewhere else. I didn't want to repeat anything from the Series B.
You're describing it like a dream. It's like, where was I? And Steve, you were there, but you were in your car.
You were there, and we were talking about verb.com for 20 minutes.
Right. As one would.
So I was just like, okay. And Adam, I got to hand it to you. As I was listening to this, I was like, okay, we're like 15 minutes into this, and we're talking about like us trying to get money out of verb.com. And you're like, isn't there another reason that we're here that we should be talking about? So you did a good job of getting us back on.
Hey, we're only 11 minutes this time.
Yeah, exactly.
We had none of that conversation.
We're way ahead of schedule.
So yeah, I think we don't need to talk about verb.com, the .computer TLD. We spent like 20 minutes talking about domain names before we got to anything.
All right, fine. I will not bring up the fact that we got inundated yet again.
I know.
All the .coms.
All the .coms. Yeah, so did you get it? I got inundated. I felt I got inundated more actually with the B than the C.
More on that in the B, but some new unlocks in the C. So apparently in the B, we did not qualify for the suite salespeople. And by suite, I mean SUITE.
SUITE.
So we had the Golden State Warriors suites, the 49ers suites. We did not make the Giants or the A's. I guess that must be Series D.
We did, however, make the Ballers.
We did make the Ballers.
So,
which is great.
You know, it's looking up. We've got some exciting plans brewing there.
No sweet plans, just to be clear.
No Warriors Niners sweet plans.
That's right.
No, that's right. You know,
it doesn't mean there's not sweet plans.
Yeah, we're not taking Indie League sweet plans off the table. Not right now.
Not yet.
Yeah. We've made it to the minor leagues, finally.
I will thank you not to refer to the independent leagues that way.
Oh, the one that actually did make me chuckle is along the lines of like major mass market sports team suites.
Yeah.
The oscilloscope and protocol analyzer companies came inbound.
Oh boy! They smell blood in the water.
They were like, "Ooh, now's the time."
Now's the time. Because actually,
that's
frankly,
right. Because $200 billion is just the price of
the price for
$100 million Series B. That's enough for a lot of things. Not enough to buy a scope, but $200 million Series C. That's. Yeah. So we should talk a little bit about kind of how we in terms of the announcement, how we got here. So we had when did we actually close the C? What date?
July.
No, the B. No, not the B. The C. Or the B. No, take it from the B.
Yeah.
We closed the B in July.
Closed the B in July.
And then announced that we deliberately announced that we had a plan. We did a PR push. I would say, can I just say this for any potential founders out there? We got kind of talked into doing a formal PR push around that funding announcement. I think
because you need to. I mean, you need to warm up the reporters, and you want to tell the big story. And
those are always a waste of time.
It was a waste of time.
I think those are always a waste of time. I just think that like their time is just better, and we kind of knew it was a waste. I hate when we
Well, I mean, it has a bit of an analog to fundraising because you have to go talk to a whole bunch of potential story writers.
Yes.
To get to land the one. And you have to spend hours and hours and hours. And, one could argue like, oh, you're warming up like potential other reporters who are eventually going to write. It's a lot of time.
It's a lot of time. I just did not have the juice was not worth it. And we knew like, it's actually when we do the B, it's going to be the blog entry that gets the actual traction, not the actual, like the news stories. I mean, I would trivia question, like who actually published on the B that was under embargo, right? Versus publishing because they see the blog entry. And so we kind of, on the C, we're like, we're definitely not doing that. Not going to do, we're absolutely not going to go do a roadshow with journalists. So we closed the C, I want to say it was December 23rd, wasn't it?
Yes.
Right before, yeah. Right.
It was technically the 24th, but yeah.
Technically the 24th. Look at
Christmas Eve.
Christmas miracle. So we closed the C and had, I would say, no specific plans to talk about it. No, I mean, trying to make news out of fundraising is not worth spending much time on. And we had a bunch of other things that we want to talk about, new product platform, customers, et cetera. So in this one, we took actually, Adam, I feel that, laziness being one of the virtues of programmers, yes. The lazy evaluation has got some wins. And in this case, a reporter saw the Form D and reached out to us and explained that they were going to publish on this. So we're like, okay. And we talked to the reporter, had a very good conversation with them about like, okay, you want to publish about this. And because I think we talked about the Form D last time, but this is for regulatory compliance, because this is what is it is it the change in bylaws or is it just any fund? I actually don't know what the actual kind of triggering thing is other than you have to do it whenever you raise.
You have to file it when you raise.
And
you have 15 business days from the time you close.
So,
and again, we talked about this before.
People sit on that. And
a lot of people like to sit on it so they can do one of these big announcements that is not in compliance with the SEC.
Well, I think we kind of did a good job in that in January because the reporter couldn't believe that no one else had written about it.
Yeah.
He's like, I kind of stumbled on this. And it's like, no one seems to have written about it, and you haven't talked about it. Like, do I actually have a scoop here? Like, you kind of do.
Yeah, I saw that Form D come out, and I sort of expected the hordes to like show up at our gates, and they just didn't.
They didn't. And actually didn't get the sales hordes also.
Yeah, exactly. So those folks are usually much more on top of it. Like, sure, the press or whatever, but they got their hands full. But usually it's like folks wanted the oscilloscope folks showing up.
The oscilloscope, like the yacht salesmen and their kind of virtual equivalents. Because I don't think they understand that. I don't have that personally. That's not what happened here. Sorry.
Well, yeah. I mean, there was also all the wealth management folks come out of the grid. It's like, hey, good news, still zero.
Right. Exactly. When the reporter was going to write on it, like, okay, we need to actually. Well, this will be fine. We'll just get our blog entry out there. Reporter was very accommodating of moving their schedule back a day or two, so we could actually get our blog entry out there. So that's kind of in terms of like why we announced this thing now. That was kind of it. We didn't really intend to make a big funding push. And when the blog entry was out there, I mean. And Adam, you kind of pushed it out there, and you're like, "Well, I mean, we'll see if this is a top Hacker News story or not." But it did end up at the top Hacker News.
Come on! Like the
I would be when there is like this kind of protracted period where it's kind of hanging out there for like 15 or 20 minutes, and you can kind of see it having a limited number of upvotes. Like, all right, well, maybe the world is just kind of sick of it, and I can't really blame them at some level. It's like these guys again. Yeah. Did they just do this? But so anyway, but I think we want to backtrack a little bit and maybe Adam, we can, explain why we raised the C so quickly after the B. Cause I think it's fair to say, Steve, that everybody, including employees, was surprised by this. I mean, Adam, I think it's fair to say that employees did not see this coming.
Totally fair. Yeah, absolutely. I think I think it made sense, but yeah, folks did not see this coming at all internally.
So, Steve, why did we raise? So we raised $100 million B in July, and here we are, not 6 months later, raising a $200 million Series C. I mean, have we not seen Silicon Valley? But no, of course we've seen we've seen.
You're saying I could have raised less?
I could have raised less? Fuck. Such a good scene.
Such a good scene. Well, we weren't planning to raise, that's for sure. And we had just gotten through what was, I think fundraising in hard tech in the earlier stages is never pleasant. And the Series B was terrific because we ended up with new investors and all of our existing investors that were really excited about putting capital into the company and where the company was and where it was going.
I would say that one of the reasons it's not pleasant is that because it's so enticing. I mean, and I think I'm sure we've described this over the years before, but one of the problems we have at Oxide is that individual partners at VC firms fall head over heels in love with us. And they take us home to the parents and it doesn't go very well. And that is a long maybe or a long no.
Yeah.
And that's what you get over and over and over again in hard tech.
Yeah, I mean, so many of these firms want to be a yes, but they can't get 100% firm conviction. And it is fear of jumping the gun before a company is ready, and then immediately flips to fear of missing out. And it's just VCs are living in one of those two paradigms. And so Series B was convincing folks that all of these sort of seeds we had planted commercially and the improvements operationally and the continuing growing team we had the right ingredients and good market tailwinds, and the time was right. And it was, again, kind of convincing folks to get over the line. And we had, again, found a terrific lead investor in USIT. And I think we talked about in a previous episode, just and maybe we didn't talk about the structure of the B.
I don't think we have never talked about the structure. And I think it is actually worth talking about the structure a little bit because I think this is not something that people necessarily give or get insight into. And on something like this, I don't know how unusual it is or isn't, honestly, because there's not transparency into how this stuff is structured. So yeah, I think it is worth actually elaborating a bit on the structure of the B.
So we had a number of great investors that were interested in leading the Series B, and
she said we wanted to raise like 50. Yeah, that's what we were thinking.
Yeah.
Raise like $50 million.
What we were aiming for is, again, we had a bunch of this kind of pent up momentum that had not yet broken out commercially, and we certainly needed to raise for runway extension, and we were looking at.
Like that euphemism.
What a great euphemism.
Yeah.
Runway extension.
Yeah. Like we're not also making payroll. Right. We're not making payroll. We're extending the runway.
Right. Exactly.
Because we are rapidly approaching the end of the runway.
We need runway extension.
And we're still on the ground.
We're still on the ground. We just need runway. Yes, we need it soon. And yes, we're traveling down the runway
at increasing speed.
Yeah.
So we and we're working with a couple of great potential firms to lead the round, and folks are of course kind of negotiating to drive to what they think is the right value for being able to strike the balance of opportunity and momentum and then the eventual kind of commercial acceleration. And so there were opportunities that were more straightforward, and then what we ended up landing on was a tranche structure that kind of struck the midpoint, sort of the balance of what we believed in terms of the momentum of the business and where we were, and where one might try to price things at that exact moment.
So you should describe a tranche structure, because I think tranche is not necessarily a term that people would be familiar with. I think they're more common in the life sciences. I don't think they're all, well, anyway, just explain what a tranche structure is.
So basically it takes the size of a round and it divides that up in, I guess it could be multiple tranches. And maybe oftentimes the life sciences.
I think the life science it is, yeah.
Where it is,
yeah.
If and as you get to this particular breakthrough in a particular research area, you can kind of unlock higher values of the company. and or unlock the capital.
I think in the life sciences, it is more frequent that you're unlocking the capital. I think it is more that it's a tranche round, and like when you hit FDA approval or when you
get 33%.
That's right.
33%.
Yeah, right. Yeah.
And so maybe it preserves a little bit of optionality from an investor perspective, but it gives that research firm, or in this case, the company, the ability to bet on themselves a little bit.
That's right.
And the risk associated with that is maybe if you are not able to hit those milestones, then you, in some cases, do not get access to capital. In other cases, maybe you end up with a value that is not representative of maybe a point in time negotiated value. And in our particular case, we were not going to agree to anything that was going to put at risk the capital.
That's right. Yeah.
So we were
not going to be a regulatory milestone.
And we had opportunities to go raise the fullness of the round
Yeah.
At terms that I think, relatively speaking, were fair. But in this structure, it allowed us to bet on ourselves a little bit and say, we'll take a portion of the round at this current valuation, and then if we hit a milestone, then the second portion of this round will be at a valuation that we think is fair given the momentum of the business.
And if we don't hit the milestone, importantly, the capital is still committed.
Yep.
But the valuation would be
at the original number.
At the original number.
That's right.
And you and I had already kind of done the calculus of like, well, the valuation that would be non-ruinous dilution. It would be like the company would be
good,
it'd
not
be good.
great.
It'd be good, not great. Yeah, it would not be. But it would also, you and I have always said from the very beginning, the biggest risk that we have is capital risk. Something that VCs never wanted to hear, by the way. They're like, other risks. No. Like this is an important one. VCs, like this is your
why
job.
You're here, right?
This is why you're here. You do this one, and it's like we actually did have a VC who was like, I'm just very concerned about the capital risk. It's like
you are the capital.
You are the capital. You can mitigate this one. Like this is
other people's capital, not mine.
Biggest lever you have by far.
So, but this we like that. I mean, I
it was definitely it was.
I thought it was great.
At the time, I think we definitely like a lot of execution to go do over the period of time against that milestone. I mean, it wasn't a layup by any means.
It was not a layup. I did love the fact that like it was definitely not a layup. The milestone that they had picked, which was a bookings milestone by the Q1 of 2026.
12-month booking.
Yeah. And it was like it was an aggressive milestone, but it was also. They were kind of reasonably be like, well, this is like the plan that you have. It's like, yeah, I know it's the plan, but it's an aggressive plan. I mean, it's aggressive.
That was the plan when we wanted your money.
That's exactly right. That's exactly right. Now that like, oh, okay. And I mean, hey, to their credit, it's hard to have a rebuttal to that one. Like, no. I mean, of course, no. I mean, it's reasonable. It's just reasonably aggressive. But it was. I think also the thought was too that like, well, if we don't hit the milestone, if we miss it kind of grievously, it's like, well, then it's like it's going to be kind of it would be very nice to have, because you and I are always mindful of things that are out of our control. And it's like these are long sales cycles and things happen out of your control. And I mean, sorry, Steve is already getting a long stare of just like all of the memories of. I mean, you literally have. I mean. We had, and I was just reminiscing about this with the person who was on this deal. We had a deal that was on the goal line where the person was going to get on the call with us to explain that we'd won the deal. It's at Oxide. And they're like, I was going to get on the call to tell you that you'd won the deal, but now I have to tell you that my entire group has been let go.
This morning.
And we've there's organizational chaos here. And like, this is my last day.
That's right. Instead of cloud modernization, it is people cutback is the new strategy.
Yeah, it's a new shift.
Did they cut out for you guys? Is that just me? Okay, lost them. Great, perfect.
Okay, how about now?
Perfect.
All right, I received a phone call.
Did you go ahead and do that?
And yeah, well, you know what? If we are nothing if not transparent.
It's a phone call. Wait a minute. This is a phone call from USIT.
Just conference them in.
Oh, we got you. They're listening in here. Wait a minute. Hold on. End of the podcast, everybody.
It's been real. All right. Let's get the do not disturb.
Yeah, there we go. We can make sure that doesn't happen again. Sorry about that.
Things outside of our control.
Things outside of our control. Totally honest. Well, you just know that there are things like that absolutely happen. And We've seen that happen so many times, Steve. I think this is like why you there's a certain degree to which it ends up being scar tissue that ends up being we don't count on anything until money is wired, basically, just because so much has gone wrong. And there was just plenty that could go wrong, and it felt like we could miss this milestone for any number of reasons outside of our control. And we wanted to be sure that if we did miss the milestone, especially with economic headwinds and everything else, if we missed the milestone, the company lives was our priority.
Yeah, we would have years of runway to be able to ensure that the company lived.
Right. So that was the rationale for the tranche structure.
Yep.
And I don't even know what you exactly call it. I think this is an unusual structure, and I think it was.
I think so too. I mean, we found that out as we took it to the rest of our investors. I mean, it was pretty quickly evident.
Right. It's like, Oxide can't do anything like a normal company. It's like gotta be weird. Everything's gotta be weird with you. It's like, is there anything that's not weird with you people? It's like how we mentioned that we did our own switch. Yeah. Stop talking about it. Just but it was a good structure, and I would actually recommend. I mean, it's something to recommend. I remember when we were raising the seed,
something to contemplate.
We were talking about a tranche structure with folks, and that got totally shut down. They're like, "Wow, you guys are just born weird." But I think it's a good hard tech structure. So we were happy with that structure, and our job was like, go execute, hit these milestones, and.
Well, it should be said. I mean, we were planning on raising 50. We ended up raising 100.
100.
And so it was kind of, we had thought about it as effectively like $50 million Series B and a $50 million Series C sort of combined.
That's right.
And so we got the round done, and then it was on to execution. And we had in the kind of previous months just a bunch of building commercial momentum. And in this particular domain, you've got somewhat longer sales cycles where folks are evaluating a material strategic technology partner, and then they have to go through kind of the validation process with one before they're going to contemplate many. And so we had been planting a lot of those seeds over the previous 12 months, and again had confidence that things were building, but had to go execute. And suffice it to say, over the next several months, a bunch of those things started to blossom.
Yeah, I mean, and it is important. Like a bunch of things. I mean, we always think of the things that are out of your control that go against you. But there are also things that are out of your control that break in your favor. That are also, just the right person comes to the right organization at the right time, or the right person happens to have been a fan of the podcast, or those things that are just kind of like happenstance at some level. And we just had a bunch of those break in the right direction.
Yeah, which was fun because we quickly got to and surpassed said tranche milestone.
Yeah.
And along with that, of course, is a bunch of renewed investor interest.
It was really sad. I mean, when we blew that milestone out, and you're like, we're calling the rest of the capital. I'm like, oh right, I guess we are. That's great, right? So we ended up blowing that milestone out much earlier. Yep. than we thought we would, which was great, and was really that was really satisfying.
And again, back to the flip, it's like, oh gosh, things are so close. If just there was one more enterprise deal, if there was just, which it never is just one, but once we had a number of things start to break, very quickly it went to like, greed, fear of missing out. I mean, because this is the world of venture capital, is that you want to put as much money as you can behind companies that are successful.
Yeah, so I think this is a really important point, Steve, because I think that this is the way the venture model works. Is you put a bunch of small bets out there and you spread them around. You've got portfolio theory. I'm going to put a bunch of like little bets if they're pre-seed, and then the bets are going to get gradually bigger and bigger as the stage advances. But when you have a company and so you would think like, oh, okay, I get it. Like the model is you put a bunch of bets out there and one of them's a winner, and the one that's a winner is enough to pay off like the ones that aren't a winner. Most of them are zeros. And the one that is, the one that is a non-zero is a non-zero to the point that it can make up the others. And that's true, but it's definitely true, but there's an asterisk on it, which is when you do have a winner, you want to own as much of that as possible. And that when you are investing in these companies at an earlier stage, it's not just the investment. There's some optionality that you're preserving for yourself that as an investor, like, hey, if I'm a good partner, I will be in a great position to really be able to put a lot more capital into the company. And we had some investors that they were very explicit about that, being like, this is why we are investing, because we want to be able to put in more capital.
That's right.
Later.
And that, I would describe that a little differently than a bunch of investors that have been kind of hovering for 3 years just crash landed back in. And that's I think as compared to existing investors who, the reason that we have them on the cap table is because they are long-term investors, and they were not only comfortable with, but excited about the proposition of building a company over, 10 years. And so along with a lot of these other investors that, again, had kind of like done drive-bys at the Series A and the Series B, it was exciting to then contemplate what it would look like if we were to go do a Series C and be able to do that potentially with investors we have around the table.
Yeah, exactly. And there was actually a very funny moment when one of our investors, we kind of closed the B. I mean, it's some level of coincidence. I mean, not totally coincidental, but we basically made our VCs look like absolute geniuses, is what I'm trying to say. Like the B closes, and then like the company very shortly thereafter is like, wow, okay, this is like, you've got all of a sudden a lot of like long, and these were like long percolating things. Right. That kind of happened to hit at once, and we ended up with a lot of traction. And so our investors look like absolute geniuses, which I think is kind of fun. I did enjoy that.
Yeah, definitely.
Making them, their secret was safe with us. I mean, I guess we're kind of, calling them out now, but
not so safe.
Not so safe of a secret. They are geniuses. We didn't make them just look like geniuses. Do you know why we made them look like geniuses? Because they are geniuses, right. Every single one.
But I will say, whether it was outside capital or, even in conversations about how we should further capitalize the business internally, there were a number of things that we needed to go stress test in the business first.
Yes.
And, not to say that we were not operating a capital efficient business before, but as we were scaling up these commercial opportunities, we were picking kind of speed and obviously quality over unit economics or cost.
Right.
We were prioritizing investing in things that would help us go faster, scale faster, ensure we had allocation and inventory. So a couple of examples. I mean, we were wire transferring money up front to be able to get access to parts of our supply chain even before the DDR5 crunch.
Yeah. And important to say that at no point were we, one of the nice things about being a hardware company is like, you can't really sell it at a loss. Like that's not only is that not, like you can't even do that once. Unlike, I think there's a lot of VC-backed companies where you can kind of have a kind of a loss leader for market positioning. You really can't do that here. So it's like when we say we hadn't worked on the COGS.
But even if you increase volume.
That's right. Right.
First things was like just supply chain management. So we had interest in raising more money and just said, look, we have some things that we have to go get tightened up in the business that include thinking about how we negotiate better supplier agreements so that we are paying in arrears, to then also think about inventory carry. We have a contract manufacturer. We were doing all first party procurement, and when you're doing that, rather than leveraging their procurement teams and them holding inventory on quarterly turns.
Yeah. So, and just describe that a little bit. What is first party procurement, and why is that an impediment to kind of your best possible COGS?
Yeah, and definitely an impediment to your best possible COGS. And so the reason for that is that you are paying dollars upfront for materials that you are then building your product with, that you are then selling to your customer, and then they are paying you, and you have to cover that whole carry, from the time that you buy those materials to the time that your customer pays you for the product. And so when one is working with a manufacturing partner, as part of that agreement, you negotiate terms. It says, we will carry inventory for X amount of time, and they normally want to do quarterly turns so they can kind of cycle those things off the books. And as long as you are meeting your demand schedule and you are buying from them effectively that fully built out product in time, they will carry inventory for all those materials. So that's great. Yeah. I mean, that's hugely important for cash flow conversion. And so as you could imagine,
it should be said, the cash flow conversion, this is as we've said, there's like for any given company in our kind of shared past, there are things we really want to emulate. And this is something out of Dell that we...
it was held up, the negative cash flow conversion. Dell and Costco are kind of the two companies that are the hallmarks of this. But Dell would negotiate terms with their suppliers that were not net 30, but more like net 90. And their suppliers would rent space on their factory floor so that they would not buy that hard drive until you had ordered the laptop, paid with a credit card so they already had your cash. Then someone a line worker walked down and like scanned one of the hard drives off of Western Digital's little island of real estate in Dell's manufacturing factory. And then it would go out the door like 6 hours later.
Amazing.
So they would have, 100 days like throwing off cash in that whole purchase cycle, which was crazy. So, I think we're a long ways from that.
We're not doing
because
that, exactly.
we're doing the opposite of that, right?
Yeah, right.
Like we're wire transferring $7 million to buy parts and then consigning it at our manufacturing partner.
Right.
And so when I first went to kind of test this with our operations team, you can imagine, CJ and team are and Kirsten and folks, I'm like, hey, why aren't we leveraging our manufacturing partner to do procurement and be able to pick up that inventory carry?
I can see this is a bad time. I'll come back later.
and they were like, yeah, no, totally. Yes. Why don't we do more of that? That sounds great. I'm like, and they're like, by the way, are you okay if we have some real load-bearing projects that are trying to ship in December and you end up with a 4-month slip because there was a particular SKU that was incorrectly ordered by an analyst and I'm already just backing out of the room.
Right.
No. So, what you trade in a little bit, and if you do it well, like you can solve for both of these, but there is a certain amount of expertise that you gain when you are dealing with procurement first party for what is a broad bill of materials over years, and versus you are training up another procurement team to go do this. And so this is that kind of like balancing where we want to go from all first party procurement and consigning, which is very capital inefficient, but it is kind of order fulfillment, high confidence,
right?
To starting to blend that out. So we had to figure out like what is the percent that we want to effectively outsource from a procurement perspective and gain the benefits of inventory control management over say 90-day turns versus what we want to keep first party. So that was step one. And we don't need to talk about whether we should raise more money or not before we've figured that out.
Right,
We're like wildly capital efficient there, inefficient. We can go figure that out first. The second piece the third piece after supplier term negotiation and then inventory negotiation is debt.
Right.
Because when you are buying a bunch of materials for high confidence customer orders, which means creditworthy customers and high confidence of fulfillment, this is what debt is great for.
And the debt guys do love us.
The debt guys love us.
Because we make a physical stuff.
That's right.
When they were looking at because they get to actually collateralize it against the actual the physicality of it, and we did try to explain to them it's like I'm not sure if a gimlet is going to be in this kind of worst case of you're kind of like reclaiming an Oxide compute sled, like not really sure what the bones are worth it. But hey, you know what? Let me not get.
They're like gimlet, pal. There's DDR4 in that thing.
That's right. Yeah, right.
Like. Just like I'm going to go strip the copper out of that.
Right. I guess that's it. Yeah.
Yeah. And so it's not to say that you want to fulfill all of this with debt, but this is what it is built for, is being able to borrow money and borrow that money for the period of time between when you have to buy the materials and or pay your contract manufacturing partner for the inventory turn to when you are going to receive cash from the customer.
Yeah.
And that's how you get to like a zero cash conversion cycle, and maybe even push into the negative. But Debt plays an important role in that. And we really had not kind of productized any one of those three areas. And so that was, while we were having conversations about whether we need to raise, which we didn't think we did, it made sense to go stress test that stuff first. And conclusion of all that was we definitively do not need to raise.
Do not need to raise.
So then the question
which
was,
unfortunately is catnip to venture capitalists. Like that is like, we do not need to raise. And by the way, like here's our quantitative model showing just how much we don't need to raise. And also we've got all this business traction. So why would we raise? I mean, that is basically an aphrodisiac for venture capitalists.
Well, especially with their asymmetric knowledge, right? They know this, right? Our insiders know this, but like the rest of the world doesn't.
That's exactly right. They know this, but the rest of the world doesn't know this. So this is like, this is where they have to actually maximize their ownership to make their model work. And there was a very funny moment when investors like, we have to talk about your capital needs. And Steve's like, I think we've pretty definitively shown that we have no capital needs. And there was a little bit of like friction. And then Steve's like, I think you mean your ownership needs. It's like, yes, my ownership needs. Yes, I thank you. And it was just like, it was a good like conversation with your doctor. We can just like, look, I'm your doctor. We can really just talk about it, frankly. And it's fine. Like we get it. Like we understand the way their model works. And actually that we've got some things to gain from that too. I think that this is where you kind of get to like, okay, so why they've got ownership needs, fine, but we actually don't have capital needs. So why would we raise? Why not just like, we don't actually need it, why raise it at all?
So the couple of things that we were chewing on, we were contemplating this, and one of them still, even if it's kind of a lower concern than it was in the B, is just make sure we can prepare for stormy weather.
Lower concern for you. I mean, I feel that's never a lower concern. That is like, I am just like.
Then the B. I think the B was like, okay, we gotta brace for storminess.
Yeah, brace. Yeah.
And sure, maybe it was a hangover of that same fear of storminess, but I think like it was a consideration, not the consideration.
I just think the .com bust is never going to come out of me.
Deep score.
No, it's deep. No, it really is. It is like, and it must be for you as well. It's like there were so many things that couldn't happen that did happen in the .com bust.
Yeah.
And it is just never going. I mean, in fact, I've always been concerned that it would cast a shadow in the wrong way, and we wouldn't take the risks we have to take because I would be too risk averse from the .com bust. But
plus, there's so much that rhymes with the .com bust right now.
Yes,
and so many economic conditions and things that don't make sense, like tariffs being illegal and going into effect at the same time. I mean, I just think there's so much uncertainty.
In addition to our finding that World War II is stressful, it is an uncertain climate. Yes, it is a lot of uncertainty. And
so that was one piece of it.
Yeah.
I think one of the bigger reasons, provided that it kind of made sense from a terms perspective, was we were no longer in this experimental phase with large enterprise customers.
Right.
And I think kind of like you saw in the, kind of 2010, 2011, 2012, as folks had begun like trying public cloud and then being, starting to determine like, this is actually a substrate that I could depend on more. And then what does this mean if I'm going to actually start adopting this? Like what's the longevity of service, or, how do I think about it architecturally? We had started getting to phases with customers where they were not thinking about like, okay, well, what if we quadruple the size of our pilot? And we're really starting to ask questions of like, what do the next 36 months, 48 months, 60 months look like, going from a more traditional substrate that we have been running on for the last 10 years to one that is much more modern and cloud first. And, oh, wait a minute, that all rides on top of Oxide. Right. And how do we have the conviction and know that they are going to be here in not just 3 years, but 5 years, 7 years, 10 years? And so, I mean, put simply, one big benefit of raising is to give our customers and future customers the confidence that we are going to be here for a very, very, very long time, and that we're going to be building Oxide in the same way that we have been doing for why we started the company, why we've been kind of shaping things the way that we have for many, many years to come. And we've lived it. We've lived the byproduct of companies that have been in situations where they had to contemplate acquisition. And as customers ourselves, and then as an acquired company in a past life, and having had those conversations with the customers of like, what does this mean? You know?
And I mean, just bluntly, I think you're going to be bought by Dell. I'm worried you're going to be bought by Dell. I'm worried you're going to be bought by HP.
Yep.
I'm worried you're going to be bought by IBM. I'm worried you're going to be bought, and we're worried you're going to be bought by EMC. And for every one of these, like, we know all of the stories, and we've seen it over and over and over again, where companies lose their independence and customers suffer as a result of that. And I think it was when we were doing the analysis, the financial analysis of like, all right, what does this mean? It's like, and the person we had doing the analysis was outside of Oxide, was like, well, so just so you know, like if you were to raise a Series C, it would make an acquisition much more unlikely. Like, great. that is great, because that is not the objective of this company, is not to be acquired. It's not to be because we know what that means. And that's not what we're doing. We're a big independent company. So, but there was, in order to be able to do that though, so that was a big reason to do it, but we had to be able to do it in the way that, I mean, when you raise this kind of capital, I think there were a lot of questions out there, Adam, about like, what are the VC strings attached? And that's it's a good question to ask, because like there are strings attached. And so what kind of strings are typically attached, and how do we avoid those?
Yeah, I mean, so typically when you're raising a large round and you have a large lead investor who's coming into the round, which was
new
the
investor.
case.
Yeah.
Yep. In the Series B.
Yep.
We had a large new investor come in, and one of the things that changes is board dynamics and composition, because you have a new board member coming in. And in some circumstances, maybe if you've got co-leads, maybe you have two new board members coming in, and that then kind of changes the dynamics, changes the voting structure, changes can change a bunch of how the company is governed.
Yeah, and the board of directors controls the company. Just to be clear,
Yep.
Like you report to our board.
That's right.
That is ultimately makes and so it's a very big deal. Like,
it's a big deal.
What does the board structure look like is a very big deal, and there's a big difference between a board member and an observer. And a board observer is allowed to be there in the board meetings, but that board can go into closed session. The board observer and then that observer does not have a vote. They are truly an observer.
Now, I would say that we have been extremely, extremely fortunate in that our board is not what? What are you laughing at?
Like, extremely fortunate is kind of like almost like not the words.
Okay, good.
It's like what's luckier than that?
Yeah, no, right.
I mean, if you had told us when we started the company 6 years ago that you will have raised your Series C and have a 4-person board, of which you two jokers, Steve and me, will be half of the board.
Yeah, almost $400 billion in, and 4 board members, 2 of whom are the founder, CEO, and CTO. That's unique.
It is unique. We basically jumped from a building and lived. I mean, it's when we started the company, my belief was when we actually hit the Series A, you and I would no longer control the company. I mean, that's just the way it works. Like, if you don't want to do that, don't have a venture funded business. Don't go into solving hard things. It's like, at some point, like, people are going to invest capital, and they're going to, and I think that, we had an advisor to the company, because you and I have always, it's always been very important to us. The advisor of the company, I think, had some good words. Was like, just so you know, like, there are, in most companies, the founders are not in mathematical control, but that doesn't mean you don't have a huge amount of influence over the board.
Right.
And so, that's kind of what we anticipated. When we started the company, I thought,
and therefore you want to make sure that you pick your investors carefully, and you got to make, you want to make sure that you have got as close to, you want as good alignment as you can get. And so that means, making sure that the whole process of fundraising is like trying on working with someone, and they're trying on working with the founders. and you want to understand that this person believes in this big opportunity and the mission, and that it's not always going to be easy, and it's going to take a long time. And it's a long time now. And we got very lucky.
Well, I'm just being reminded, like when sometimes we would tell VCs that, and they would get more interested in Oxide, not less, for the wrong reasons.
I know.
Because when we tell them, like, no, we're going whaling, like, I want to go whaling. It's like, no, we're gonna die at sea. You actually don't want to go whaling.
But these relationships end up being extremely, extremely important. And being able to have hard conversations with each other and take in new information and kind of process that and figure out what that means for what's next for the company. And we, I think along the way got very, very lucky with investors on the board that had the same view and same conviction that we did.
It's funny because we can think about that. Like, we got lucky that it was just hard enough to raise. Because, if it had been easier to raise, it would have been easier to have investors that didn't have quite the conviction.
Totally.
Or if it had been
shook out
it shook out people that would have been poor fits. Yeah. I mean, the thing that's kind of wild is like that we.
I mean, there's so many times we're thinking about like just some pretty big waves that we were in over the last couple of years, and just some investors that were really close that would have just been hurling over the side.
Oh yeah, no, not ready for this. Just not ready for this. Because they're not ready for the levels of technical risk involved. And we've always been very transparent about. We've always been let the passengers know exactly the waves we're going through. But we've gotten, I think, really, really lucky. And you and I can. There are lots of investors that would have not been, but we kind of self-selected for the ones that are been really durable, which has been great. We've been very, very, very fortunate in that regard. And then, so the ability to raise that kind of money with that
keeping the same
structure and not having to go to new investors.
Yep.
So
again, keeping it with a crew that has these large customers' best interests in mind. I mean, that really is what it comes down to. Having investors that care about your customers and wanting to build and grow long strategic relationships with those customers, which leads to a big company, a durable company. And, you've got, not all investors are equipped the same way to do this, but investors that are excited to put more money in the company as it gets further along in its life. And those are, we're fortunate.
And so that was the good news. Now, the Series C, raising it did have challenges that we didn't have in the Series B. And it was challenging for some different reasons, but I think it was actually for us both. I mean, it was, there were some challenges. These are, I want to be clear, these are good problems to have.
Still problems.
But they're still problems. And so, because as the round starts to come together, we don't just have sufficient investor interest. We really have too much investor interest from our insiders.
And outside capital. I mean,
outside capital.
It was... There was definitely a lot of interest. And again, it was unfamiliar territory. In that, I think previously we'd had a lot of interest, but it was a lot of window shoppers.
It was a lot of window shoppers, yeah.
And
versus like apex predators. I mean that, I mean that with all professional courtesy.
That's right. But it was definitely in some ways a less fun round, even if not quite as stressful as the Series B and the Series A, because the Series A and the Series B, you're kind of like getting all parties over the line, and it's a little bit more of a celebration. And when you have a bunch of firms that want to put as much money as they can into a particular round, you kind of have disappointment to go all around.
Yeah.
You have a packing problem, and it's really hard. And especially when you've got investors that have been, with the company and have been investing with the company when things were not as as positive.
Yeah.
And
we've had some investors that deliberately put in a smaller amount in earlier rounds because they wanted to be able to invest more in later rounds, and have been in the interim, have been extremely helpful. And we really wanted to reward those folks. I mean, we wanted those folks
absolutely.
And so it was really important, but like, we don't, I would say we don't control it, but like at some level we're trying to negotiate kind of a compromise, because there is more interest that can really fit. And then everyone's like, well, can't you guys just raise more? So Steve, why don't we raise, which we definitely heard plenty, especially as we're trying to get everything to fit. Like, why don't you guys just raise more? It's like,
which again is, why don't you sell more of the company?
Right. And it's like, we already were kind of at the outside of what we wanted to be raising right now. We did not want to be. So on the one hand, it would, and also it just felt like it would have been, if we raised more, we would have had the same packing problem.
Oh, for sure. Why don't you raise just a little bit more?
It's like, well, now, okay, if you're going to raise a little bit more, then I actually want a lot more. You're like, okay.
Don't you believe this is going to be just a gargantuan? Why would you slow it down by any means?
Right. And then another reasonable thing, and Adam, this may be your immediate question, is like, okay, great, like raise the price, which is reasonable, but you can't do that. You can only, like, once you have a round coming together, it's really tough to go back and, there's some things you just don't want to renegotiate, because you run the risk of the whole thing collapsing, and we don't want that. We did want to raise it.
And there's an element of good faith there. I mean, you can't sort of shop it around and then say, actually, what if it's 10% more? Because there's so much
That's
interest.
right. That's right. And we, I think we talked about this in our episode with Seth, where we had a firm walk away from a signed term sheet, and they tried to reprice us, and it was dirty. Right. It was gross. They tried to reprice us because the climate had shifted in their favor.
Yep.
And we didn't want to, the climate was shifting in our favor, but yeah, Adam, you're right. There's a good faith aspect of this. So we, no, we're not raising more. We're just going to have to, some of you are going to have to be disappointed. Okay. I guess all of you are going to have to be a little bit disappointed. And I mean, Steve, you and I both love our investors. So it was painful.
All of them. Yeah.
To disappoint folks. We really, really did not want to disappoint folks. And
it was tough. It was definitely harder than the Series B in that respect.
And also then the other thing that, the other thing that made it challenging is when investors invest, they often, maybe always, but certainly very often have pro rata rights. And pro rata rights give you the right to maintain your ownership percentage of the company by investing as time goes on. And there's a bit of when you've got an oversubscribed round, what are people going to do? There are people out there with pro rata rights. And I think that there was some conventionalism oh, don't worry. They won't take their pro rata rights.
Sharp elbows is just a myth.
Yeah, sharp elbows is just a myth. As it turns out, maybe those folks haven't been around a company that, no, you should just assume everyone's going to take the pro rata rights. And that made it uncomfortable. It's like people are yeah, sorry, I've got the right to do this. So yeah, I want to invest a lot more. I know I've been, and it's okay. So we got to find a way to make it all work. And that was a lot of shuttle diplomacy from you, Steve, to get it all to fit. But I think you succeeded in that everybody was a little disappointed.
Exactly.
Good job.
Job well done.
Job well done. Everyone is a little bit disappointed. And then we closed, which is great. So
closed and
it closed without. So we did not add any new investors. Did not add any board seats. And put a whole bunch of capital into the company, which is a lot.
And it had the effect that we were hoping for, which is, while we did not want to go spend a bunch of calories trying to come up with a big fundraising announcement, all of our customers, all of our prospective customers, our partners were like, wow, it's
great.
That's big news. And gives them the confidence to just lean in further.
Yeah, which is great. And also, I think, have you found it also? I have found. I mean, this is okay. This is maybe I shouldn't be saying this in a rather public spot, but I just feel like for so much of the company, it's this might work. This might work. Okay, yes, it seems like increasingly likely this will work, obviously, but I feel that especially with the Series C, having absolute confidence that we are absolutely going to be here for a long time.
Yeah.
Like the podcast has been renewed for many, many, many seasons. It kind of changes like the disposition about the way we handle ourselves, the way we kind of consider decisions, the way we consider potential customer conversations. When you talk to a potential customer who's like, look, I love you guys, but it's like, I'm not going to be at a decision point for like 18 months. It's like that. There was a time when that would be like, no, caloric budget dictates that we'll just come back to you later. And now that's a conversation that we can like actually, we can cultivate over time. It just feels like, I felt that people have asked us like, does this stress you out? And the Series C lowers my own personal stress levels quite a bit. Is that?
Yeah. Well, how would the opposite be true? Like because it raises expectations or something?
I think so.
I'm
Adam. I think that's a good question. Yeah, I think so. I think it's because I also think that like, and this would be reasonable. I don't think people realize, understandably, when we say we didn't need to raise, people are like, okay, that's obviously just a fib that every startup says, which is what I used to believe. I used to think that any company saying we don't need to raise, I'm like, it's always a lie. It's definitely not always a lie. And I remember talking to Tom Preston Warner about the GitHub. Because when GitHub raised, and they said we don't need to raise, I'm like, it's a lie. As it turns out, it was not a lie. They really did not need to raise when they raised. And Adam, do you know the story about their term sheet?
No. Oh, wasn't it like fill in the blank or something?
It was fill in the blank.
Yeah.
They wrote the term sheet. They wrote the entire term sheet with the only numbers that you could fill in being capital N and valuation. And they sent it out to Sand Hill and they said, we're not taking any meetings. And I'm like,
it's pretty strong.
Like, damn, that's really don't need to raise. That is, and even Tom's like, that was probably a bit much. We got lucky. That's there are companies that don't need to raise. And so I think that, Adam, I think where that's coming from is, I mean, when Docker raised that kind of money, would be like, you guys should be stressed out. You don't have like a revenue model. Like that's like, you have
nothing figured out, right?
You have nothing figured out. And you've just like poured a ton of fuel onto like a fire, frankly. And it's like, so I think that that's where that question is probably coming from. But I think in our case, it's given us just a lot of confidence.
Well, I think having to go through the process of, again, sort of stress testing the unit economics of the business before doing it relieves some of that stress, because you could raise a bunch more money and then be concerned that you have got a bunch of inefficiencies in the business that are just going to get kind of propagated everywhere. And you're going to blink, and 2 years later, you're like, wow, might need to go raise again. And having gone through that, I think gives us the confidence. Now, we're still being very thoughtful about how we spend and where we spend, but
and my anxiety has all shifted to the problems that we have in terms of like, we got to make a bunch of these things.
That's right.
All of the operational challenges.
It's scaling manufacturing operations. We are hiring across every single team.
Yeah.
It was kind of funny. I saw you had a post right before we raised the B where you were like, God, 9 open recs on the career pages. Like that is more than double we've ever had before.
Yeah.
And I think we're at like 16 now.
Yeah.
And multiple, we would hire multiple people for a bunch of those roles. So, I think it just gives us the confidence to continue growing the team, and certainly to make sure that we are investing in all the things, looking at you, DDR5, that are, have started to get prohibitively expensive, and just investing in inventory and manufacturing operations, test equipment, scope providers.
Yeah. Maybe we'll need a Series D after all. But we can actually, for those who don't know, the test equipment, although actually DDR5 is beginning. Although, you know what? That test equipment has DDR5 in it, I'm sure. That it is going to get it is going to get multiplied by itself. Yeah, it's going to be an excuse for that to get much more expensive. So Adam, I know that was that was way too long for context.
No, great context. That was awesome. But who doesn't love Tranche Talk?
Who doesn't love Tranche Talk? It's a Tranche Talk. You definitely. I love a little Tranche Talk. After hours Tranche Talk.
Late night Tranche Talk.
Absolutely. So we announce, and then so I am. We get the blog entry out there, and then Adam, I feel we have to do the Passover tradition that we've talked about this before. That like I mean, Hacker News, if you're listening, wise child, wicked child, simple child, the child that doesn't know how to ask, please let us mark Hacker News comments in this way.
I mean, I don't know. I don't know if you read all Hacker News threads, but I now, and yeah, it's a great lens. Like, nope, that's just a wicked child.
Wicked.
It's like, oh, that's
wicked.
You just don't know how to ask. That's fine.
Simple, deserves a response.
Yeah, well, I like the ones that start simple and kind of dive into wicked. But there are a bunch of great comments, and I thought we could walk through some of the comments and questions. From
some of the
Hacker
winners.
News. Yeah.
Well, and also like my alts, and I think we might have discovered one of your alts in here.
We'll see.
Not to call you out, but
there are a lot of good stuff. I think just not to bury the lead, best comment I saw was, can they re-raise it in Series Rust instead of Series C?
I lulled.
I laughed out loud, and then I saw your comment saying that you laughed out loud, so I appreciate it.
I thought that was very funny. Can they rewrite it in Series Rust? I thought it was actually. I thought that was an underappreciated comment. It sounds like you thought that was an underappreciated comment too.
Nailed it. Loved it. Then just some nice stuff before we get into some less nice stuff. I loved seeing this one from RG. Said, anyway, I'm glad to hear the raise because the team seems exceptional, and I in this area that's management. Good stuff. Good luck and congratulations. Another one I saw was, God, I'm so glad to see these guys succeeding. The sun may have burned out, but the sky is still bright thanks to them. I thought that was really kind.
Very, very nice, very, very poetic there.
But to bring us back down to
exactly. That's right. Enough of that.
Actually, there's
a lot
of podcast critique. I tried to like the podcast. It's been a few years, so it may have improved. Topics were so good. The guests were great. But Bryan Cantrell was just terrible at letting his guests actually talk. Bryan, if you're listening, please let your guests talk. And then you actually had a very thoughtful response to that guy, which I thought was kind.
Of course, it's like, and this is like, it's human nature, right? Because you say the comments are basically overwhelmingly positive.
Yes.
And you got there are 99 positive comments here, and you're like, nope, it's the one comment that said that I was, and so yeah, I did. And
to his credit, he was like, thanks for the transparency. I appreciate the response. I still think you talk too much. So all of those things.
We're not gonna. I would like to point out, is now the time to point out that the last time you listened to the podcast was when we had Jonathan Blow on the Metal in 2019. I mean, that
was like 3.5 hours. That was a long one.
It was 3.5 hours, and he was accusing me of interrupting Jonathan Blow. I'm like that guy is like a weather system. If you we do not know. Humanity does not know how long he will go, because it
wasn't that long. It would have gone further.
He would have gone further, right?
Oh, for sure.
And I was freezing. Remember, we were in the garage, the literal garage, absolutely freezing. I had to pee
so badly.
Like it was a road trip. It was like one of those road trip pees where you can't pure pain. You can't even walk to the restroom, and then
I couldn't even concentrate the last 45 minutes.
Exactly. It takes 8 minutes. And so road trip pee, I am going to miss my flight. Remember, I was going to New Zealand. It's pre-COVID. We're going to New Zealand for Christmas. And this is not a flight you can miss. It's not like, oh, we'll just catch the next flight to New Zealand. It's like, this could ruin Christmas. And this guy is it was like a hurricane that had crossed Florida and fucking blew into the Gulf and was picking up steam again. I'm like, this thing's gonna hit Texas. It's like, this is this guy. And so, I interrupted Jonathan Blow. I'm really sorry that I interrupted Jonathan Blow. Okay. I did.
You sound sorry.
I did. Yeah, I know. Now you're getting my actual real thought. That comment may have been written several times to be as.
It's at least as much time on that comment as the blog post. I love it.
Maybe more.
Maybe significantly more. Well, I actually dumpster dove a dead comment because I asked the now in browser LLM. They said, I like how everyone has their own explanations and theories about what Oxide even is. ... Definitely a scam at this point. Hundreds of millions later, and not a single video of someone using the product in detail. Yet you all suck up to it because you can't handle not sharing the same opinions as the popular kids. No videos?
No videos seems like, look, we're willing to wear a couple of accusations.
You can use some things.
You get definitely, but that is a wild one.
That's a tough one.
Yeah.
A lot of videos. I mean, this is a moment. Your Friday.
FAQ Friday. FAQ Friday. Actually, and Kevin Spring, that was Kevin's idea that we need to do FAQ Friday. For those of you who are seeing too much of me on LinkedIn, it is because Kevin Spring has mastered the dark arts of LinkedIn. I'm sorry. The guy is like, he did his homework. He found like the various like technical ways that you have. So, and it is very effective. He's like, I found the ways for you to get picked up by the algorithm. So now I'm sorry. I get like really thrusted upon everybody.
And you get the walk and talks, which are, my favorite. Yeah.
And I'm still like, and as you know, I still believe you're being sarcastic when you say that. But unknowable, and it doesn't matter. I mean, does it? No, maybe it doesn't matter in the end. Yeah, exactly. It doesn't matter.
Yeah.
I like doing the walk and talks. I do like the walk and the walk and talks are much better than the alternative. Steve, you and I tried to do those when we first started doing those. We tried to do those completely.
Stand in front of a tripod in front of the rack.
It was not good.
Tough.
It was really, really tough. Actually, it's like you were trying to record 45 seconds, and Adam, it is really hard to say something,
anything
in 45 seconds. Mm-hmm. Maybe this is what the commenter on the
I know.
I've been reading comments to that effect. Yes,
exactly. That's right. But it was really hard, and so it took me like 30 minutes, and I kind of had like something that was not very good, and you were off doing something else. And they're just like, oh God, it took you 30 minutes to record 45 seconds. I'm like, yeah, I'll come back here in an hour and a half when you are.
Actually, no, you sat on the couch to watch it.
It was too tough to watch. Honestly, it was too painful to watch. I can't. But it's the walk and talk is actually a great. It's because it's and then 45 seconds feels like a more natural amount of time. So yeah, I like the walk and talk.
Good pro tip on the. There was a comment here. I don't know if it was Wicked Child or the Child Unable to Ask. And I won't read the whole thing because it's voluminous. This person satisfied raising money in substitute for growth and keep wrenching their business with VCs and letting them control business and ownership. Oxide wouldn't have to keep getting owned by VCs and would inevitably lead to shittification to pay back the VCs. If Oxide followed the model of Valve, 100% founder and employee ownership, profitable, and so forth, then it would be a different situation. So I think you've addressed this by and large, but maybe even talk a little bit in basic terms on even more basic than you've already talked about the necessity of investment.
Yeah, you can't be 100% founder owned. I mean, like that means like so that for us to be founder owned and not rely on venture capital means
bootstrap this.
Yeah, it means that Steve and I have had
$200 million.
That's right. I mean, that's like that doesn't. So it doesn't work that way. Yeah. It's like you're getting someone to invest, and that investment does not necessarily come. I mean, this is where like control and the board structure and governance all becomes like really, really important. It can get really gritty too. I mean, I think this is where there's a big difference between good deals and bad deals, and bad deals and deals that good investors and bad investors. And I mean, just bluntly, there's a big difference between kind of top tier Silicon Valley firms, and then you can go pretty far down the market where you get firms. And this, I think, I will say that this does tend to happen more in other geographies, because I think it's just less competitive from a venture capital perspective. But where, Adam, you get like, the participating preferred, and you get ratchets, and you get all this other kind of like nonsense that really does put the company's kind of in jeopardy. Now, people are raising money like that because they feel they have to. But we are not. Yeah, we are not in that situation. Fortunately, we have not sold the company to VCs. We've got venture capital as investors, but we are and resisting enshittification is very important to us.
Yeah.
So,
this commenter also was concerned that they would be acquired or IPO. It's like, well, those are other
worried about an IPO.
Those are very different things. I think I think that to be worried about being acquired and to be worried about being an IPO, an initial public offering, is when you sell a fraction of your company to the public. And that is not a failure of a company, by the way. It's just that is there are a lot of great companies that are public.
Yeah,
so
turns out. Then questions I thought about the market and a couple of from the wise children. One says, they're doing neat stuff. I wonder how many other potential customers feel that way too. What is Oxide's market? It feels like advanced alien technology that is ultimately a little too weird and expensive for most enterprises to adopt. So, a little wise, a little wicked. You take the mix. And then another one asks, how does it compare to Nutanix? Which I thought were both good questions.
Yeah, that's interesting. Yeah, the Nutanix question is interesting. I think that people are, because we do get like, who's your competitor? And we kind of assumed that we started the company, there would be a competitor that would follow us, that would raise behind us, another startup. Turns out it was a little harder to raise than we thought, and we kind of, I feel like we took all the good investors, so we didn't have the other ones.
That's right.
But that just didn't happen for a variety of reasons. That didn't happen. So I mean, Nutanix is the problem, the challenge, and I don't want to disparage Nutanix. I would just say that just in terms of what Nutanix is, and they make a hypervisor, they make orchestration software around it. They have not engaged in hardware software co-design. Like that is just where they, and initially you would buy that. I think that they were endeavoring to label hardware, but I think that at this point it's kind of bring your own. Then they've got a hardware compatibility list, and it all looks very familiar. That's what we did at Joint, Steve. I mean, that's what we had the hardware compatibility list, and you ultimately bring your own hardware, and like you can do stuff like that. But the reason we did Oxide the way we did it is because we feel that that there are problems at scale that you simply can't solve with that approach. So I would say that Nutanix is taking it's fundamentally a different approach.
Yeah, and to the comment about maybe a little too weird, public cloud has done a lot of heavy lifting to help enterprises appreciate that cloud computing is not weird.
Yeah,
and what you're presented in the public cloud is a set of elastic infrastructure services that make it really, really easy to build, deploy, and operate software. And you don't get to know a lot about the implementation details. And the more you are running on it, the less you care to, because it works and it's helping your business go faster. And we far less often these days need to advocate for the benefits of cloud computing kind of writ large to enterprises. And obviously what we believe is that you should have those same benefits in the other 50 or 60 or 70% of your IT infrastructure that today is made up of more rack and stack, kind of multiple vendors smashed together, that takes a big operational army to then serve up as virtual infrastructure to your internal constituents and give that same developer experience and operational efficiency under a totally different cost profile than public cloud, and in your own data center or a colo or wherever you need to run your business, secure facility.
Yeah.
So you can have kind of the best of all things. You can have cloud computing capabilities that you can rent from a service provider or that you can own and operate much more efficiently. And so by that measure, it's not weird at all. The questions from customers, 2-3 years ago were more like, do I want this? Do I need this? Then a year ago was like, okay, well, how do I get there from adopting a little bit of it to this thing kind of running wall to wall in my data center, to much more now? Like, are you guys going to be here in 3 to 5 years? Like, right. Can I truly depend on this? If we're making a bet that is measured in tens and hundreds of millions of dollars on Oxide, can we trust that this is the early days of what is going to be a household name, a generational company? And that was a big reason to raise. I mean, I think in retrospect, it makes all the sense in the world to have raised to ourselves. Whereas,
did it make sense at the time? I mean, we did this of our own free will.
No, I just mean at the time we didn't need to, and it was very much elective in some regards. And I think in retrospect, it's like, no, I mean, absolute no brainer.
And I think it is I probably was more fixated on just the risk elements of like the storms that we can weather. I mean, quite literally any storm with this.
Would you say that out loud? I'm cutting that from the podcast.
Nope. I'm saying it out loud. No, I'm saying it out loud, and I'm not knocking on wood.
Wow.
Okay, don't double down.
No, Jesus Christ! You heard me, gods. Bring it.
Oh,
come on, let's go.
Okay. The old triple down.
No. Listen,
Adam, you know what to do.
We have gone through bank failure at this company. We have gone through. Ring the chime for that one. we have gone through the machines that would not come out of reset. There's another chime you can ring. No.
ASIC funerals.
All right, I'm knocking on wood. Gods, I'm begging for your forgiveness. I don't know what. I'm so
Thank
sorry.
You. Thank you.
Good.
Thank you.
I have a shiny object to distract you with anyway. So.
Thank you. Excellent.
Yeah. So one person says, if I recall correctly, Bryan Cantrell has compared the value proposition of an Oxide rack to an IBM AS400, to which someone reasonably replies, for those of us who are unaware of the value proposition of the IBM AS400, could someone spell it out for us?
I think didn't someone come along and spell it out? I think.
Well,
right?
Yes, but I'd love to hear. I'd love to hear you talk about the AS400. This is like you love talking about the AS400.
I do love talking about the AS400, but I feel like if you ask me to do a walk and talk on the AS400, I'm going to know that I'm being pranked.
Okay, this is staying in the episode and everything. Like I think
I'm just saying that you will have overshot the mark if I do.
Okay,
you know what? I will do a walk and talk on the AS400. You can't stop me.
Well, if you think it's a good idea, boss.
Yeah, exactly. Meanwhile, that's right. Kevin is like, well, RIP to being a LinkedIn influencer. He's going to lose it on the AS400. The AS400, a codename Silver Lake at IBM was a really interesting project, really interesting history. It was the IBM Rochester. It comes out of the origin of actually a system called Future System, FS, which was post IBM, the OS 360 rather, System 360. And Future System kind of, I think it is one, and maybe folks in the chat can let me know, but I think Future System may be the canonical second system. I think it is possible that, Adam, I may be a bit over my skis, but I believe that's the second system syndrome, maybe a Fred Brooksism, and may come from Future System. We can go fact check all that. But that turned into System 38, which ultimately turned into the S400. And there's a bunch of value in there, very much hardware software co-design, and very much designing for the actual business case applications. So they did an excellent job of really delivering tremendous value to customers in this kind of, I think they called mid-frames. And it was an extremely successful product. I think it was one of the most successful products in IBM's history. And a bit of a veteran, or a bit of a casualty of the great IBM civil wars between Poughkeepsie, Rochester, Austin, and Boca Raton, which is kind of the history of IBM. Is those four entities that all hated one another's guts and spent all the time fighting with one another. So AS400 ultimately, I think, we were talking to a large retail customer, Steve, that had just decommissioned thousands of them, like in the last 2 years, which is not at all a surprise. I mean, you saw they were absolutely dominant in car dealerships. So there's these kind of verticals that were really. So yeah, AS400, and it was technically very interesting. So there is a great book on the Silver Lake project. I think it might be called the Silver Lake Project, but on the kind of the history of that development, but it was always kind of an inspiration. And Adam, it was an inspiration for us. I mean, you remember us talking about the S400 when we started Fishworks. It was definitely.
I don't actually.
Yeah,
I believe you.
I think it was a very direct inspiration for us at Fishworks. So and wanting to deliver that. The other thing the S400 delivered was a real appliance experience from an operational perspective. It did not require. It's just like, wow, this thing just kind of just works.
You didn't have to put it together.
You had to put it together.
And I mean, the experience of the product was just an output to make it easy to get your job done.
That's right. And
that is why it made sense to use it as a reference when raising a series seed on Sand Hill Road.
Yes, when we were raising a seed, a firm asked us, what the best historical analog is.
Final partner meeting.
Final
so this
partner
is
meeting.
like we are down to the last at bat.
And Steve's like saying
they
say
said
iPhone. Please
they
say
said
iPhone.
well
Please say
help us
iPhone.
understand like what is something how do we what's a good comparison to crystallize what this thing is, and I thought it was a great answer.
I really loved your retelling of it. Yeah, that was. I didn't realize that the company hung in the balance at that moment. And what did I say? I said the AS400.
Said the AS400, one of the most underappreciated and important technology products.
If I had given the answer in Navajo, it would have been more broadly received. I mean, it was just an absolute still pond of quizzical looks and my
in fairness, I took that and just doubled right down on it with like, well, let me reframe this for you. Think about like Pure Storage or Nutanix. And that was also not the answer.
Not the answer they were looking for. But you know what? I think they forgot all that because
they did because it as predicted.
As predicted, because Robert Downey Jr. appeared in the partner meeting.
They had like simulcast between the New York and the Menlo office, and he pops in. He's like, "What's happening? Is this like one of those pitches?
Yeah,
how's it going?"
And Jess did say all they're going to remember is that Robert Downey Jr. was there. And I think that is actually all they did remember.
That is, and they said that was the best partner meeting we've ever had.
They did say that.
Their words.
They said it was, and like that is not it. Anyway, I should have given them a pop quiz on the AS400. Sorry, Adam, long answer.
No, I love it. I mean, I wouldn't have kept it in the mix if I didn't. If I wanted just a walk and talk, I want the sit and talk.
Exactly. The walk and talk on the AS400.
A couple of simple questions I thought about the product. One says, "I'm confused. What their product is? The cloud you own? Isn't that just a server? Sure, it looks like a very nice server, but is there anything special about it apart from that?" You know, Steve, you talked a bunch about the value of cloud, and we've talked at length on the podcast about what makes the servers great. But do you feel like there's some answers for that kind of question?
Yeah, and we, it's understandable because we've bitten off a lot here, and it is akin a bit to like what's the thing that makes the iPhone special? Just like pick one thing. Like tell me what is so special about it. And the answer for that too is kind of, not complicated, but there's a lot there. There's a lot of different things that
functional
are really...
audio with Discord.
Exactly. 4 words. Right. Next conference. But I think when you try to solve for outcomes that deliver some of the benefits that cloud computing delivers, yes, there's all the kind of the developer benefits, which are more qualitative and speed to be able to get their job done, provision infrastructure, et cetera, that you don't get out of. A server is a piece of hardware that needs a whole bunch of software to do anything interesting, and a cloud computer or the infrastructure that the hyperscalers run in support of cloud computing look nothing like what off-the-shelf servers and storage and networking equipment look like, because it was designed for the purpose of extending an API to a software developer that allows them to not have to plan ahead based on their app, the hardware that they're going to buy, and then assemble it and run it. The service is going to do all that for you. And if the needs of your application change, guess what? The infrastructure is going to be kind of reconstituted without you having to be exposed to it to support those changes in applications. And so from a developer perspective, it is simplicity. It is the ability to use modern tools to be able to deploy and manage software. From an operations and a security and a financial team's perspective, the differences are really stark, because it turns out when you design a rack scale system for the same kinds of things that the hyperscalers had to go design for themselves, which is how do I get much better density? How do I get vastly better energy efficiency? How do I get, how do I have systems that are much easier to operate? Well, the outcomes are you can get a system that will do twice as much for the same kilowatt of energy. And especially when things are extremely power constrained in on-premises environments today, that really matters. And you can't get there by tuning a particular server. You have to kind of take a holistic approach and be thoughtful about the architecture and design of that. When you build a system, I hate to call it back to the AS400, but when you build a complete system, you are just kind of plugging it in and starting to operate against it. And today, on-prem is a mismatch of different things that need to get unboxed and integrated and combined and tested and then handed off to the teams. And that often takes weeks or months before a developer's on that infrastructure. And with Oxide, it's an hour and a half. And
there's been some of our most gratifying moments.
It's really meaningful.
When being with a customer when they're provisioning their first VM after, I mean, it's pretty delightful.
And there's Fortune 500 IT teams that are today trying to figure out, how do I run shared infrastructure across these different business units that have to be inherently isolated without having islands of infrastructure that I run in a low utilization manner and 5x my infrastructure costs. And to have a system that already has multi-tenancy built in, where you can have shared infrastructure and you can run different BUs across it that have inherent isolation to the standard that the hyperscalers have for themselves, and have a security substrate that supports that. And so, if Amazon or Microsoft or Google were sitting here today, they'd be like, God, I mean, come on, you're touting all these things as like innovations. This is how we run our business. And that was that big cliff where on-prem never had access to these those sort of outcomes. And so it's a lot of things, but most simply, it is kind of the old adage, like better, faster, cheaper.
You mentioned Amazon. I can blow by this comment. Someone asks, are services like AWS Outpost from public clouds the main competitor for Oxide?
AWS Outposts.
Knowing of AWS Outposts, I want to give credit to the commenter. Like that's
yes, I
appreciate that.
Yeah, I was going to say if AWS Outposts were more commercially successful, it would be a big competitor. AWS Outposts kind of looks similar, but it's very...
Well, to start, I think AWS Outposts, like from the concept of bringing cloud computing capabilities into one's data center.
Sounds great.
Right. Good vision.
Adam, have we talked about this on the podcast before about our shared discovery of AWS Outposts? I'm not sure we have. Well, if we have, we're just gonna...
maybe not. Yeah.
So it is the fall of 2018. It's reInvent 2018. I have told exactly one other person about Oxide. It is you, one of my oldest and dearest friends.
Thank you.
I had to tell you 3 separate times because I thought you couldn't hear me. And I would say our friend Lucas, but I think it's your friend Lucas, I guess, would turn to me and said, he heard you. I'm like, okay. And you finally turned to me and be like, you want to start a computer company like Supermicro? I'm like, okay, this is all right.
This is going badly, right?
This is going over. It's like,
gotta work on this pitch.
I'm going to work on this pitch. Thank God our BART train's here. And then I felt like it was, we can actually, we can figure out when it, because that was election night, 2018.
Yes.
Because you and I were because we were at the Beastie Boys out loud reading.
That's right.
That was an extremely narrow Gen X event. That like you were absolutely born in the 1970s. Like you were not born earlier than 1970, and you're not born later than I guess. So Adam, you're born in 80, right? So I guess it was
no 79. So
79. You're 79.
Yeah, legit Xer.
You're legit Xer, right? Anyway, and then it's a reInvent. So like whatever, a couple weeks later. And they announce Outposts.
That's right.
And I am looking at this thinking like, I think AWS just killed our company. I haven't even started it. And as I'm kind of like emotionally kind of processing this, I get this very cheerful DM from you saying, I think Amazon just killed your company.
Yeah.
And I'm like what? They can't do that. Like they're killing companies that haven't even been started yet. I mean, these guys are absolute animals. And I I actually had one of my most viral tweets. I tweeted out at that reInvent. I was not there. I was watching it remotely. Although I guess if you're there, you're also watching it remotely because no one can actually get into the hall. That I'm waiting for the reInvent in which Amazon locks the doors and goes full red wedding, announcing that every attendee's product or service is a forthcoming product or service from Amazon. Or maybe that was this year. And I think that got obviously that got retweeted from a bunch of folks because a bunch of folks feel that way. With that their offering was becoming an AWS offering. But I don't think people realize, no, I was talking about Oxide. That was an Oxide subtweet. We literally didn't have a name for the company, and Amazon had already killed it with Outposts. But I had a bunch of questions about is it rented or owned? I think it's going to be rented, but they didn't. This was by 2018. reInvent had changed. It used to be the reInvent announces something, and Jeff Barr is demoing it on stage, and you can provision on it right now. And it was just, they were such killers. And I think by 2018, that was starting to fade. And now we're actually kind of putting things on stage that actually aren't available yet. Oh, by the way, we don't have any details on this. And there's kind of some stagecraft to it and blah, 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 blah. But the full economic analysis, Adam, I think you were one of the first ones to really take it apart. I think that's right.
That's my recollection. Yeah. I don't remember folks kind of digging into it.
And you were digging into it in part because I'm going to prove to everyone that Oxide is doomed. Is that being too reductive? Maybe that's being too reductive.
I don't think that's true. I think I was contemplating my future prospects and wanted to see if Oxide was doomed. That's slightly different.
Right. Oh, okay. Yeah. When you emphasize the words differently in the sentence, it does have a slightly different implication. Yeah. No, okay. Yeah. Right. But I think what you discovered there is economically, this thing is pretty grim.
Yeah. Disaster. Yeah. I mean, really priced. I mean, you say that Outpost was an economic failure. I actually think it's a success. No, but hear me out. I think it's a success in terms of they don't want to sell it.
Yes.
They want to sell public cloud. What they want is to tell about how they don't want to sell you public cloud, and then once you start seeing the numbers, you just decide to buy the public cloud anyway. So I think
it's an Outpost.
It's got crazy a fox. That company.
I think you might be kidding, but they are crazy like a fox.
They are crazy like a fox. I will tell you that I do know Outpost was extremely controversial inside of Amazon. And Outpost was kind of a civil war inside of Amazon. And it was very contentious. And I think that it is. I don't. But maybe that's all part of the no. That is what the fox wants you to believe. These rumors of organizational strife is actually a deliberate misinformation campaign. Which, hey, you know what? The truth is, I wouldn't put it past them because they are that good. So who knows? Yeah. I think the big problem with Outposts, you got a couple of big problems. The economic problem is a big one. It's very expensive. And then I think that you also have customers that no. This has to be on-prem. The cost, I don't love the cost, but okay, fine. It is the connectedness back into Amazon and the necessity of that, and then that becomes load bearing.
Yeah.
So it's US East has an outage for 4 hours, and Outposts were down for 18.
Yeah.
And I think people think when I'm running in my own data center, some of this availability risk I'm mitigating, and you're kind of magnifying it because Amazon has made decisions for your Outposts that make sense when you're deploying thousands of racks, but doesn't make sense for the 2 Outpost racks that you've got.
Yeah.
So yeah, I think that Outposts it is trying to solve a similar problem, although we're really trying to address the economic problem. But I think for folks that are using Outposts because of its locality, and obviously disappointing Amazon by being customers of AWS Outposts and undermining their master plan to actually commercially fail with it. I think that Oxide looks very compelling.
Yeah. I thought it was a good opportunity to address. One person amid other comments says their hardware is multiple generations behind at this point.
Yeah.
I wonder if there's and that's we had some recent announcements about that. I thought you might talk about that?
Yeah, I think that I know. Like, look, I'm sorry, we do things because yes, we've done a podcast on the bring up of Cosmo, like quite some time ago, but there may not have been a real marketing launch
and not announced Cosmo.
It may be otherwise unannounced. We may be selling it without having announced it. Like
Until now.
Exactly. Welcome to the Cosmo launch. I think poor Kevin is
having an aneurysm.
Wait, hold on. Didn't
Kevin
we talk
is
about this on the register? Is that not true?
No, we did.
We did.
Okay.
We did.
Thank God. I was like, oh God, Kevin is coming.
No. We definitely have. I mean, this is why Kevin's like, this is why I can't work with you people.
Right.
Because we have not done a formal, and I think the website might not even reflect it, but yeah, we've definitely been selling it.
The website will very shortly reflect it. We, in fairness, have just started shipping it.
Yes, it has been shipping only recently.
Do you think the folks at Amazon are like, wow, those guys didn't even announce it? And someone's like, no, that's just their whisper campaign. They're playing 5D chess. They're just trying to juice up demand.
God, this is just like we talked about in the pre-show.
Yeah, I did. I did hear I got a colleague from Amazon who was there when we announced Oxide, Adam, and they actually it kind of made me feel good. They were actually laughing at us. It's great.
They're like, so like, play it again.
Yeah, exactly. We brought them mirth, which I think is great. Actually, I didn't think we merited that kind of attention. I think we merited the laughter.
In the Atlanta, we do see people like watching, like some people watch the walk and talks over and over again, and I guess we know who they are.
But yeah, briefly, we part of the design of the system is to allow customers to adopt new technology without having to replatform.
Yes.
So one of the difficulties of kind of traditional non-cloud infrastructure is that when you want to adopt a new chipset, you want to adopt a new platform, there's a bunch of work you've got to do in between that hardware and your application software to validate all of that. And when you're running in AWS and there's a new instance type, there often is new hardware underpinning that. And we wanted to deliver as close to that experience as possible. So with this new platform called Cosmo, which runs on AMD Turin chips instead of what you see right now online, which is reasonable for one to infer like, wow, you're running on AMD Milan.
AMD Milan, I guess.
Yeah, it was long in the tooth in 2022. You now can get racks that are all Cosmo, which is all Turin based. You still can get Milan, which by the way is like extremely energy efficient, and there's a bunch of value around that. And then you can mix the two, so you can have different types of sleds in your series of racks so that you can have different classes of instances, and you can point internal workloads at one generation, kind of one pool of resources or another. And along with that announcement soon to come, we are also...
The one you just made?
Yeah, the one I just made.
Yeah, you got it. Yeah.
Well, it just 3 more seconds.
Yeah, okay.
And but we are continuing to update software as we go and landing new software services that will show up both in existing customer racks and then anyone that is buying our next gen systems right now. So new storage service and new networking capabilities, and again, kind of like in the fashion of public cloud. These are new capabilities, both in hardware and software, that should just be showing up over time without you having to kind of forklift up and out what you have paid for and bought.
And see our podcast episode with Dave Pacheco on how we update you. Sorry to make you ring the chime again, Adam, but that was a good one.
Ring it again. So getting towards the end, but there were a couple of ones about...
Yeah, you bet.
I thought we could 1%. As a teenager, I dreamt about working for Sun. Oxide comes close in a way. I already know it's out of my league. However, the podcast too, with regard to is the only company where I check the career, hoping that they have a position that I can apply to. Happy to see their success. And then one person
we do have an
says,
RSS feed. I think people do hang around on RSS. No, it's in terms of like new, because I think it's and we already have folks at Oxide who a role opened up later that was a better fit for them, and they are now been colleagues. So,
And one person noted, I thought that the process of writing the materials was great. That person was ultimately didn't become an Oxide employee, but I just wanted to echo that like the materials do take a while, but I found very instructive myself, years ago when I was doing them. But
I think that they're helpful to figure out what you want to do.
Yeah. And it should be noted that you go to careers.oxide.computer and there are many job listings available there now. Along those same lines, someone says, wow, amazing. That's some serious money. What do you do with so much money? And I'd love to hear the answer to that. But just before you say it, one of the responders says, if they buy all the DRAM they needed for their near future before prices spiked, they probably need more than 200 million just for the DRAM. So in addition to DRAM, what's the plan with the money?
Wrong.
So DRAM, then test equipment, then
Warriors tickets,
and then we're kind of like, I don't know. Now we're scraping the bottom of the barrel, getting enough for a chicken sandwich or
Series
two.
D.
And
No, but wait. The DRAM just apprappreciated in the last 10 minutes.
We are now selling off some of our DRAM to make
right.
payroll. That's right. Yeah, we are.
We've been getting paid in DRAM for months now.
That's right.
Which you probably would take.
Seriously,
absolutely.
Seriously.
That's like the miners being paid with the gold nuggets. That's a good question. I mean, that's a good question for you, Steve.
Yeah, I mean,
there are a bunch of things we can go do constructively with the cash.
There are, but there are also things that we constructively can do with the Series B cash. So among the things are, again, we are not going to completely flip into outsourcing procurement. We are definitely still taking on some first party risk and also assurance that we're going to have the materials to be able to build larger and larger projects for our customers for years to come. And so it gives us a little more flexibility to invest into that. We also are expanding manufacturing operations more and more and more. So that means more dedicated lines for Oxide computers kind of being manufactured. It means more test equipment kind of broadly.
It means potentially more manufacturing sites.
Manufacturing sites. We're supporting customers that are
global expansion.
They're going to be outside of the United States, and it means that we are able to again grow the team at pace, kind of in every conceivable dimension, and that includes much broader support and warranty and field services coverage for our customers who don't just want crates and crates of Oxide racks to show up, but would love us to help as they are deploying them, integrating them, expanding in their own environments. And so, on the one hand, investors are like, well, we don't want to just put money, transfer money from our bank account to yours.
Right.
That doesn't make sense.
I did love there was a moment like, what are you going to use? What are you going to use this new capital for?
Right.
Well, as I
surely you'll deploy it.
As I told you, we don't actually need to raise. So, I mean, but there are things that do open up when you've got it.
Totally.
It just,
it almost all aligns with making sure that we're staying ahead of our customers.
Yes.
And we have a lot to go build.
Yeah, absolutely.
Well, congrats to the team. And been exciting to watch the journey. And we've got a lot more runway ahead of us now.
Yeah, we got a lot more runway ahead of us. The podcast has been re-upped for many more seasons. And Adam, I know we hear from employees, but also increasingly customers about how they're fans of the podcast. And they don't seem to mention me interrupting guests, but maybe they've listened since the Jonathan Blow episode. I am trying to. I do listen to myself. I'm very self-conscious about. I try not to interrupt. So I do. I'm now reading from the index card that you put in front of me.
Time to wrap it up.
Exactly.
Yeah.
But thank you very much. And thank you all the folks that are, we obviously huge debt of gratitude to everyone involved, to obviously the team, but the broader Oxide community.
Yes.
It is Oxide and Friends. And I think, Adam, the question that you didn't ask that I think does merit an ask is just how many hundreds of millions does it take before someone could get an Oxide t-shirt? What does someone have to do for an Oxide t-shirt? And I know that people were being very, very gentle by not asking that question. But I know you got that question on your mind, and I'm going to say that we've got some special t-shirts that are in the works. So stay tuned on that. But I think we do we want to get folks some swag. So
awesome. So regardless of whether it's 2X or 1X swag, I guess stay tuned.
I think stay tuned for some swag. Yeah, we're gonna have some good swag coming out, and we'll figure out how to get it to you. But thank you all for people have been hugely supportive. We really appreciate it, Steve. When we raised initially, we said that the internet was going to be rooting for this company, is what we told folks, and we have always believed, that's not sufficient, but it is necessary. It's great to have those fans. Like, we need to actually make a product that works, and we need to have something that's actually solving customers' problems and so on and so forth. But having all of you be out there rooting for us, it really is deeply meaningful for us. So we really deeply appreciate it.
Carried us through tough times and just all that much more fun in the high times.
For sure. We appreciate you. And if you need any help working on that crusty boss of yours, or educating the new one about the importance of an Oxide rack, I'm happy to help you out on that too. So thank you. And thank you again, Adam, and for doing an excellent job of pulling from the Hacker News threads, I gotta say.
Well, it's very positive. So it's fun to read through all the praise.
Yeah, it was kind of amazing that we didn't get caught in any of the Oxide divots there. So
yeah,
who knew? All right. Thank you, Adam. And see you next time. See you for many more episodes to come.